Natural gas futures closed the week lower, weighed down by a bearish mix of early season demand weakness, an unexpected storage injection, and persistently mild weather. Despite midweek efforts to stabilize, sentiment turned increasingly bearish by Friday as traders grappled with signs that spring conditions may be arriving sooner than anticipated. The season's first storage injection further reinforced this outlook, stripping away a key layer of fundamental support that had helped sustain prices in recent weeks. Meanwhile, warmer than normal temperatures have dominated much of the U.S., curbing late-season heating demand. Forecasts indicate widespread highs ranging from the 50s to 80s, keeping residential and commercial consumption subdued. While a few cold fronts are expected to move through parts of the east and west, they appear too weak and short-lived to significantly impact demand. With mild conditions projected to persist into early April, traders see little reason to anticipate a notable rebound in heating-related consumption. On the supply side, U.S. dry gas production remains strong, keeping the market well supplied. LNG exports have also rebounded, reaching 16 billion cubic feet per day last week. However, despite robust exports and inventories still running below average, these factors have not been enough to offset the bearish pull from mild weather and seasonal demand shifts. Traders are watching closely for signs of rising exports or a decline in production, but with no immediate shifts on the horizon, bearish sentiment continues to dominate. WTI crude futures edged up 0.3% on Friday to settle at $68 per barrel, securing their second consecutive weekly gain with a 1.6% increase. The rally was fueled by escalating geopolitical tensions and supply-side adjustments, as new U.S. sanctions on Iran and a fresh OPEC output reduction plan reinforced bullish sentiment. The U.S. Treasury introduced sanctions targeting Chinese refineries and vessels involved in importing Iranian crude, intensifying Washington's maximum pressure campaign aimed at curbing Iran's oil exports. Analysts estimate that these tighter restrictions could cut Iranian crude exports by as much as 1 million barrels per day, tightening global supply. Adding to the market's bullish momentum, OPEC announced plans for additional production cuts ranging between 189,000 and 435,000 barrels per day, extending through June 2026. These reductions are designed to counterbalance scheduled production increases set to begin in April, helping stabilize prices amid shifting demand dynamics. Despite the downward pressure from moving averages, WTI maintains a bullish near-term structure, supported by geopolitical supply risks and OPEC production discipline. These fundamental factors continue to provide a strong underpinning for prices. A decisive breakout above $69 could ignite fresh buying interest, paving the way for a short-term push toward the $70 to $72 range. Meanwhile, key support rests at $66. So long as prices remain above this level, the overall bias stays to the upside, keeping the market positioned for a potential test of major resistance levels. From a technical perspective, the key net gas level to watch in the coming week is the pivot at $3.86, which will serve as a critical gauge of market sentiment. How traders react to this level will likely determine the next major price move. A sustained hold above it could offer some stability and open the door for a potential rebound, while a decisive break below would leave the market vulnerable to further downside pressure. If support at $3.86 fails, selling momentum could accelerate rapidly, potentially triggering a steep decline as traders rush to reassess their positions. In such a scenario, deeper retracements may come into play, though the 52-week moving average at $2.84 remains a distant target. While a drop to this level cannot be entirely ruled out, current market conditions make such an extreme move unlikely in the near term. Nonetheless, traders will be closely monitoring price action around these key technical markers for signs of a shift in momentum. Please, drop your thoughts in the comments. Do you think natural gas has another shot at breaking the $4 resistance, or has the inevitable downturn already begun? Please like, subscribe, and comment to support the channel. See you in the next one.